Hey everyone, and welcome. Today we are going to break down a major new tax law that's about to change things for millions of us, starting with the 2025 tax year. There is a lot to unpack here, so let's just dive right in.
It really feels like every single year, just when you think you've got a handle on it, boom, a new form, a new rule, something else to figure out. It can be honestly overwhelming. So the big question on everyone's mind is pretty simple. With another huge law in the books, what's actually new for the taxes we're all going to be filing?
So, this new piece of legislation is officially called the 2025 Reconciliation Legislation, but let's be real, it's got a much catchier nickname, the One Big Beautiful Bill Act, or just OBBBA for short. It was signed into law on July 4, 2025, and it really does two main things. It makes some of the recent tax changes permanent, and it introduces a few brand new but temporary ones.
Okay, let's get into the weeds. To really wrap our heads around this new law, we first have to look at the foundation it's built on. See, OBBBA took a bunch of key rules from the 2017 Tax Cuts and Jobs Act, you probably remember that as the TCJA, that were all set to expire. Well, this new law basically locks them in for good. This is the new baseline for everybody.
First up, and this is a big one, is the standard deduction. You know, that set amount of money you can just subtract from your income right off the bat if you don't want to itemize things like mortgage interest. The TCJA basically doubled it, and now OBBA is making that much larger deduction permanent. And as you can see, the numbers for 2025 are even a little bit higher. For a single filer, you're looking at $15,750. For a married couple filing together, it's $31,500. This is a really big deal because it makes filing way simpler for a huge number of people. And right along with that standard deduction, the 7-bracket income tax system is also sticking around. What you're seeing here are the permanent tax rates. Your income gets sliced into these different tiers, and you only pay the higher rates on the money that falls into that specific bracket. So everybody pays 10% on their first chunk of income, then 12% on the next, and so on. The basic way your tax bill gets calculated, that's not changing.
Now here's the catch. There's always a trade-off, right? To pay for that much bigger standard deduction, the old system of claiming personal and dependent exemptions was wiped out, and OBBA makes that removal permanent. See, you used to be able to subtract a chunk of money for yourself, your spouse, and every one of your kids. That's gone. The whole idea was to roll it all into one big, simple deduction. But here's the thing. This swap doesn't affect everyone the same way. For a large family that used to claim 5 or 6 exemptions, this bigger standard deduction might not actually make up for what they lost.
Okay, so that's the permanent stuff. But now let's move on to the new wrinkles OBBBA introduces. These are some brand new tax breaks, but, and this is a big but, they're temporary. They're also targeted at very specific group of people and are only on the books from 2025 through 2028. This is where it gets a little more specialized.
So here's a quick look at the 3 main temporary deductions we're about to break down. There's a new one for people who earn tips, another one for workers clocking in overtime, and a special extra deduction just for seniors. Each one is designed to give a little help to a very specific slice of the population.
This first number, this is a huge deal for anyone who works in the service industry. Under a new rule they're calling no tax on tips, workers can now deduct up to $25,000 of the tip income they report. And yeah, this is a dollar-for-dollar deduction. If you earn $20,000 in tips, you could potentially deduct that whole amount from your taxable income. It's a massive shift in policy.
All right, next up we have the no tax on overtime rule. This lets eligible workers deduct up to $12,500 of their overtime pay. And if you're a married couple filing a joint return, that cap actually doubles to $25,000. Now, this specifically applies to overtime covered by the Fair Labor Standards Act, and it does require your employer to mark those wages on your W-2 form. And the third major temporary break is for our seniors. Taxpayers who are 65 and older can now take an extra deduction of $6,000. And this really shows how the law is layering these benefits. This is on top of their standard deduction or any itemized deductions they might be taking. It's just a straight-up reduction of their taxable income.
Okay, now for the fine print. And this is crucial. These new benefits aren't for everyone. All 3 of these deductions, the ones for tips, overtime, and seniors, they all start to phase out once your income gets to a certain level. For single filers, that phase out usually kicks in around $150,000 of what's called modified adjusted gross income, which is pretty much your total income minus a few specific things. For seniors, it's even lower, starting at $75,000. And they also specifically require you to have a Social Security number that's valid for work. All right,
Let's shift gears and talk about what is, hands down, one of the most important and confusing parts of the tax code for families, the child tax credit. OBB does make some tweaks here, but they're being layered on top of a system that is already incredibly complex. And to really get why this is such a challenge, you have to look at how it already works.
You know, at its heart, the idea is so simple. The child tax credit is a benefit meant to help parents with the insane cost of raising kids. You get a credit for each qualifying child, and that credit directly lowers the amount of tax you owe. But that's where the simplicity ends. The devil, as they say, is absolutely in the details.
I want you to just take a second and look at this. This isn't a joke. This is a direct quote from the real IRS instructions for Schedule 8812, which is the form you have to fill out to get the child tax credit. It is a maze of if-then statements, line references, and special rules. This is what a normal person is supposed to read and understand just to get a benefit they're entitled to. It's wild.
So in plain English, what on earth does all that IRS speak actually mean? Well, it means the rules are a complete minefield. According to the IRS's own internal guides, there are dozens and dozens of error codes just for this one credit. Things like weird residency tests and complex income calculations make it one of the top reasons people make mistakes on their taxes. And those mistakes can lead to major delays in getting a refund. And while OEBBA adjusts the credit amount, it really doesn't do much to simplify this underlying maze of rules.
Whew. Okay, we have covered a ton of ground. Permanent changes, temporary new rules, and a heavy dose of complexity. So let's just boil this all down. What do you absolutely need to remember from all of this as you start thinking about the 2025 tax season?
Here are the 4 big takeaways. Number 1, the standard deduction is higher for good, which is a net win for a lot of people. Number 2, the trade-off is that those old personal exemptions are gone permanently. Number 3, if you earn tips, work overtime, or you're a senior, you absolutely need to look into these new temporary deductions, but just remember those income limits. And finally, number 4, the tax code, especially when it comes to valuable credits like the child tax credit, has not gotten any simpler. You really have to be careful. And all of this really leaves us with one final thought. This new law, it simplifies things in one way by making the standard deduction bigger, but then it adds all these new layers of targeted, temporary complexity in others. So when you're navigating a system with so many specific rules, phase-outs, and exceptions, it's worth asking, as the tax code keeps getting more and more complex, who really benefits from all that complexity? It's something to think about. Thanks for joining this explainer.
Let's talk about the One Big Beautiful Bill.
I know, it sounds like a placeholder, doesn't it? But that is the actual name.
Is the actual name, enacted back on July 4, 2025. And if you're, sitting there staring at your 2025 tax forms, you might be thinking things feel a little different.
Oh, they are. OBBA, as the industry's calling it, is a massive overhaul. It locks in a lot of old provisions, but it also adds some completely new stuff for families.
Right, and our mission today is to decode all of that. I've been digging into the new Schedule 888 and 12 instructions, and there's a real good news, bad news story here.
There really is.
So let's start with the good news, the child tax credit.
The headline number has officially bumped up. For tax year 2025, the CTC is now $2,200 per qualifying child.
Up from $2,000.
Mm-hmm. And the refundable part, the additional child tax credit, is now capped at $1,700.
Which means, even if your tax bill is $0, you can still get a check from the IRS for up to $1,700 a kid. But the really big shift here is permanence, right? We aren't waiting around for Congress to renew this anymore.
That's it. OBBA made the credit amounts permanent. And the income phase-outs too. $200,000 for singles, $400,000 for couples.
And they finally adjust for inflation.
Starting in tax year 2026, yes. So the value won't just, erode over time.
Okay, that all sounds great. But this is where we get to the bad news for a specific group of people.
You spotted the gotcha.
It seems like the whole philosophy of who gets this credit has changed.
It has. The new rules are very strict. To claim the CTC, your child must have a valid Social Security number issued for employment.
And not just the child, right? I was reading that the filer, the parent.
Correct. The filer, or at least one spouse on a joint return, must also have a valid SSN for employment.
So if you're a taxpayer who files with an ITN, an individual taxpayer identification number, you're just locked out.
You're locked out of the CTC, yes. Even if your child is a U.S. citizen with an SSN.
Wow. That's a fundamental change from residency-based to work status-based.
It is.
So what's the fallback for those families? Is there anything?
They get pushed over to the credit for other dependents, the ODC. It's still $500, and that's now permanent too.
So it's something, but it's not $2,200.
It's not, no. It's the same credit you'd get for, say, a 17-year-old.
Okay, let's pivot to the long game part of this bill, because while the CTC got stricter, the savings incentives got a lot more generous.
Yeah, the adoption credit is a perfect example. A huge win here.
What's the change there?
Well, the credit is up to $17,280. But the game changer is that it's now partially refundable up to $5,000.
So you can get cash back even if you don't owe any tax.
Exactly. It helps families with liquidity during a really expensive process.
That is huge.
Mhm.
And speaking of costs, 529 plans also got a big upgrade. It looks like they're trying to make them more like general education accounts.
That's the idea. You can still use $20,000 a year for K-12 tuition, but crucially, the bill now lets you use the funds for non-tuition costs.
Non-tuition, like what?
Books, online learning tools, even private tutoring.
So if I'm paying for a math tutor for my 5th grader, that's a qualified 529 expense now.
Yes. It's a real incentive to start funding these accounts way before you're even thinking about college.
Which leads us to the brand new vehicle, the Trump accounts.
And yes, that is the name that's sticking.
So what are these exactly?
Think of it like a tax-advantaged savings account just for kids under 18. You can put in up to $5,000 a year. It's not deductible, but it grows tax-deferred.
And you need a new form for this, right?
You do. It's the new Form 4547 to get one started.
I saw something about a pilot program, a sort of baby bonus.
That's right. For U.S. citizen kids born between 2025 and 2028, the government puts in a one-time $1,000 contribution to kickstart the account.
Interesting. So stricter immediate cash, but more tools for long-term savings.
That's the trade-off.
Okay, before we wrap up, a quick reminder. That refundable ACTC we talked about at the start.
Right. Don't spend that money in your head just yet. Because of the PATH Act, the IRS can't issue those refunds before mid-February 2026.
Always the catch.
Well,
So what's the final takeaway here? This feels like a major shift in policy.
It is. We're seeing a clear move away from broad, immediate relief for all residents, like with the ITN exclusion, and toward, incentivized long-term asset building specifically for citizens.
So the question for new parents changes.
It does. It's not just about next April's refund anymore. It's about your financial strategy for the next 18 years.
Something to think about while you gather those receipts. That's it for this deep dive. Good luck with the paperwork.